Good day. Today we're talking about passive income rule changes. Pretty neat concept. If you have a corp, holdco, and an operating company and you're worried about your passive income, you've come to the right place. I'm Rob Tatro from robtatro.com, head of the Tatro Wealth Advisory Group here at Canaccord Genuity. And if you want to learn more about this after you've seen the video or at any time, go to www.speaktorob.com. We'd be happy to book a no obligation consultation. I'm with here today. Adam Buss is with me today, I should probably say. To the right of your screen, to the left of my seat in this wonderful blue couch. Adam is our wealth and estate planning specialist here at Canaccord Genuity. Thanks for being here, Adam.
Thanks for having me here, Rob.
Yes, my pleasure. Always fun to chat about interesting stuff like passive income rule changes. So when did these happen and what do people need to know?
So those in the small business community had quite a roller coaster ride through 2018 with a lot of tax changes being announced. So January 1st, 2019 was a major change. So that's when the new passive income rules came into effect.
Passive income rules came into effect. So first of all, what's passive income?
So passive income is quite a wide category, but let's say anything that's basically not direct active business income, which would be, let's say, rental income on a rental property portfolio, investment income, which could be interest, dividends, capital gains, anything along those lines. And there's a few other categories as well.
So mostly a rental and investment income.
That would be the big ones.
Okay, so you have, I would imagine you have, would that be inside of your operating company or would that be inside of your holding company? And does it matter if it's in the same company?
I'm going to say for this purpose, it doesn't really matter.
Okay. So the people, the individuals that have a corporation that have passive income, what do they need to know about and what do they need to watch out for? What number is the concern?
So the magic number right now is $50,000. So if you have more than $50,000 of passive income inside your corporation, then anything over that can reduce your small business tax deduction limit. So to break it down, right now, every dollar that you earn under $500,000 of active business income, you get a fantastic corporate tax rate. So right now in Manitoba specifically, it's at 9%. Okay. So 9% tax rate on the first $500,000 of income. Pretty good deal, right?
This would be for kind of every generic traditional operating company.
Operating company, exactly.
I have a plumbing company, I own a bowling alley, whatever, maybe it's a company,
Yes.
It's an operating company, traditional operating income.
Correct.
So I own this company, traditional operating income. I pay 9% on my first $500,000. And then above that, I'll pay obviously more than that,
27%, if I remember correct.
Okay, so, and those are Manitoba numbers, but
yes,
they're roughly. So now if I have passive income above 50 grand, what happens?
So that $500,000 limit starts to get grinded down essentially for every dollar of passive income that you have over $50,000 until you have $150,000 of passive income, and that limits down to zero. So that means that all of your active business income is taxed at the higher tax rate.
And the higher tax rate would be that 27%.
The 27%.
You basically lose that whole tax exemption from 0 to 500 grand. So at 150K of passive income, you're out of the small business deduction.
Correct.
You do not get it. So if we kind of reverse engineer that number, $50,000 on a 5% return or a 5% income, that would be about $1 million.
Roughly $1 million portfolio.
And at $150,000, that would be roughly $3 million. So if you're well above $3 million, you're not getting that passive income anyways.
No. You
should probably consider some kind of more advanced tax planning strategies if that is the case. But if you're between kind of that 1 to 3 million, it's incredibly important.
Yeah, I think it's important for everybody with a corporation to do that proper planning, especially now that these tax rules have come into effect.
Yeah, but Adam, someone might tell me, you know what, Rob, there's nothing I can do. I'm going to make the income I'm going to make in my portfolio. Too bad if I happen to lose my small business deduction, I lose it regardless. Is that the case?
Not necessarily. Like, we can do a lot of pre-planning ahead of time to try to structure their portfolio to probably be better diversified and also more tax efficient.
This is the one that I always pound the table on when I'm kind of sitting in meetings or talking about this. No one is talking about this passive income grind. No one's talking about it. What you should have in your corporate investment portfolio, you should be factoring in and considering the actual income that you're generating, whether it's a T3 or a T5 income, you should be factoring that. And in my humble and respectful opinion, you should absolutely be taking a look at investment vehicles that generate either return of capital through a REIT would be a great example, a real estate investment trust or a private real estate investment trust. It pays money out, it pays a cash flow out, and you do not get a T3 or a T5. Additionally, there's something you could, if you want fixed income in your portfolio, if you have fixed income like bonds or traditional fixed income, a corporate class structure could be something that you can use as well. The interest income is typically deferred or it's written off against expenses. So your actual on paper income can be significantly less, because it's one thing to earn 5% income, but it's another to earn 5% declared income on your tax statement.
It's different if it's 5% capital gains that's deferred, if it's different if it's 5% interest income or 5% of dividend income. It's trying to make sure that it's planned the right way so that it doesn't affect your tax bill at the end of the day.
Yeah, for me, it's crazy that no one's talking about this, because it's such an easy tool that you could use to reduce and save that grind, because that grind is worth, on 500 grand, you're talking 18% on 500 grand. It's a significant amount every year.
That's a lot more money that you can invest at the end of the day based on your
and
profits.
It's compounding earlier, right? So you get to have that dollar in your pocket earlier rather than give it to CRA and then not being able to invest it.
Yeah, so further to using return of capital and corporate class funds, you can use a tax-exempt life insurance policy. So those are still considered that you can shelter some additional cash and earnings inside a tax-exempt life insurance policy.
That would be corporately owned life insurance.
Corporately owned life insurance.
Okay, very interesting. Adam, anything else that you can think of that on that front, that strategies where you think you could kind of improve the situation? Obviously, planning is critical.
Planning is always the key. So it's always good to have your entire team working towards the same common goal. I've probably said this in one of our prior videos together, but it's good to have the entire team, the advisor, the planner, the accountant, the lawyer, everybody on your team working towards the same common goal, which is, having more money in your pocket at the end of the day.
All right, folks, today you heard it here first, passive income, the passive income rule changes and passive income grind. If you'd like to know more about this, you want to speak to Rob, go to www.speaktorob. We'd love to book a no obligation consultation. I'm Rob Tatro from robtatro.com, head of the Tatro Wealth Advisory Group here at Canaccord Genuity Wealth Management. Adam Buss, thanks for joining me today, guys, and thanks for watching.